This video is going to be on making a stock portfolio in Excel to do a lot of different things. You can either do some measurements of your current portfolio, or you can do a sort of a what if scenario, if you will, of what it would be to buy certain stocks and sell certain stocks, things like that. So what I have here is just a blank screen right now. And first we're going to do an analysis here to see which ones we want to buy. And what we're going to do is we're going to start with the 500 companies that are in the S&P 500 right there. Okay. And we could sort these alphabetically if you wanted to, but let's see what happens if we do that. Okay. So now what we're going to do is we're going to take all this and you're going to go into data and then you're going to click stocks. Give that a second, and then you should get an error bar. Might get some error bars over here on the right. Yep, because it's going to want you to select over here, it's going to want you to select the correct stock. And you can see that. And so you just got to go through and select the right ones. Pretty sure it's going to be these. Usually it's the top one. Sometimes it's not. But mostly want to go for a New York Stock Exchange. These OTCs, we're probably not interested in that stuff. We're definitely not interested in Australian securities. So let's see, that's a London Stock Exchange. So we got to find, here's a New York Stock Exchange. Couldn't find that one. That's fine. So we'll just delete that one. Oop. Okay, looks like they're all taken care of. And then we're just going to stretch this out so it all fits. Okay, and then we want some data on this stuff. So let's skip this down. Let's push this down so we have stock name. Then we're going to start with price, and we want volume, and we want PE. There's a couple other things we could get, but like your book value and stuff like that, I'm not sure. We'll see what options we have here. So we're going to go with, you're going to do equals. You're going to click on this cell over here. We want the price. So you're going to scroll down through these options right here and click price. Okay. And then volume. There's volume right there. And price to earnings. Let's see what else might be of interest. You can do description. Number of employees is a really fun one because you can divide total earnings by employees. And if you have two companies in a similar industry, then you could compare earnings per employee to see how profitable each employee is for the company. Industry is important. So let's start with those because PE is going to help us. This right here, industry and PE is going to help us parse down this a lot. So we're going to go down here and we're going to create our kind of our barrier here. All right, and we're going to go back up, highlight these. Let's see. Okay. Fill down, hit G1, push those out, or it's Alt-H-O-I to, okay, so we have a failure right there for no PE. So this happens if they don't report or if the PE earnings are negative and not recognized by the system. Same thing here. So these are going to be companies we're not interested in. Okay, so let's go ahead and push this into a table. And then right here, we're going to do, there's a lot of different ways you could do this. We're going to do is greater than 20 because the average for PE ratios is over the last 100 years is 20. And then we want to sort this large to small. As you can see this is way overvalued. So I wouldn't buy that. You do what you want, but this isn't stock advice, just the way to look at stocks. But all these are way overvalued. So I'm not interested in buying these. These ones are really close. I should actually change these because it's right on these are right on the cusp of maybe dropping. So I might be interested in this, especially companies like Huntington Ingalls, Accenture, PPG. Caterpillar is really close too. So let's change that to, let's just say 22, because we're still gonna have hundreds of other companies we need to parse through. So it's greater than 22. Yeah, there we go. Okay, so then we want to select these and we're gonna delete those out. And then we're going to clear the filters. And then we want to, does field show up? Yeah, so field shows up. So what we want to do is select all, take that out, and then do field. We only want to see the ones with field. So we can't get good information on these. So we can't make good decisions on that. So we're going to delete those out. I know some of those pretty big companies, James Smucker might be good. Could look that up and see what's going on, but whatever, it's not showing up, so we can't use it in our evaluation here because it's not going to give us good numbers. So clear those filters, and then we're left with 193 companies right off the bat. Okay, so we want to do sort smallest to largest on the PE ratio. Oh, these zeros got to go. That means that there's issues with the earnings. So we're just going to delete those out. And now we're left with 174 companies. Okay. Now you've got industries. And what we could do here is, let's see if we can get here with, so you've got consumer goods and conglomerates. See if there's stuff here, like stuff we're not interested in. Let's see. I'm not interested in, let's say we're not interested in automobiles, banking, beverages, computers, phones, consumer good conglomerates, containers and packaging, diversified retail. Interested in this, not interested in this. Okay. So now we have the industries we're interested in investing in, and you do that a lot of different ways. Figuring out what industries you invest in, stuff that's more sensitive or less sensitive to economic downturn. You know, for example, Chevron. If Chevron goes out of business, like America would be gone, because look at all the oil and gas that you need for operating everything. Doesn't matter what industry you're in, what Chevron fuels everything, right? So Chevron, Exxon, they all fuel everything. So this you can keep in there, and they're below 100-year average PE. People are always going to need to put fuel in their car. Whether it's grocery stores are always going to, as long as there's food going to the grocery stores, you're still going to have truck stops buying fuel to fill up their fuel tanks and fill up the semi trucks to get food to the grocery stores. So now we're down to 174 companies. Now what I'm going to do is, one other thing I like to do is use I don't think that there's a data integration here, but if we do equals and then we look for, no, I don't see it in here. So what you can do is you can set up in a brokerage account with something like Fidelity or Vanguard or something like that. Something that gives you access to balance sheets. I mean, you can also go to the Edgar data and look this stuff up, but what you want to do is find out what the total assets are, total liabilities, and then this is going to give you your book value. Okay, and so let's just say that Comcast has total assets of 13,210,123,123. And what is that? 100,000, million, billion. So yeah, that's about right. And then let's say that they have total liabilities of 8,500,123,123. Okay, so their book value is going to be total assets minus total liabilities. And you want to do this all the way down. And there's probably some API or something out there that you could either pay for or whatever to load total assets faster and total liabilities faster, so you could do these analysis faster, but no other way to do it. So now you have your book value, and then you can do another ratio here of debt to assets. So you're going to do total liabilities divided by total assets. Okay. And this is going to be a percentage. And you would just do this all the way down. And then this would be the next measure of how to weed out which companies you don't want to buy. So let me just create some. I'm not going to go through and load every single one, but let me just create something real quick. I'm just going to use random between and create some stuff here. Okay, I got these all corrected here. The only last thing I need is fix the debt to assets here. So these are just randomly generated numbers. These are not real numbers. It would take forever to go through and find the assets and liabilities for each one and then calculate the book value. So what we want to do is, now we have our debt to assets. We're going to, anything above, well, here's what you could do is, let's see if this will work for a second. So we're going to do equals average. Okay, so the average is 52.86%. So what we want to do is we're going to highlight all this, and we're going to do conditional formatting. We're going to do highlight cell rules. We're going to do greater than. See if it'll just let us do this. Light red with, okay. Yeah, so now we can see that the cells that are above the average, so a company that has above average debt to asset ratios are highlighted in red. Now I see 1.6 point. This is crazy. But again, these are all made up numbers over here. And this is a live formula here. Okay, and these are hard coded. We can sort this by smallest to largest. Oh, this broke. Let's undo that. Let's fix this formula. Equals this minus this. There, that fixed it. Okay, so we're gonna sort this smallest to largest, and then over, and then we're just gonna go down until we reach the red. I'm sorry, we wanna go from here up, and this is going to change it again, but we don't want to do that. So we're going to do control minus, get rid of all those, then we go up, see it drops, and then these go up again. And we can't keep doing that because then we would just end up with no companies, right? So we have the companies that we want to, just based off the PE ratios and book value and price, these are the companies that we're going to consider investing in. So again, this is not real. You got to populate your own stuff. Let's just manage rules and delete that rule. Okay. All right. So next we're going to start with smallest to largest on the stock price. And these are, these were live prices. Let's make this live again. Equals this and price. And fill down. Okay, so these are live. This is coming from live data from the stock market. Same thing for this. We need to fix this because I had to copy and paste this stuff over. Let's just do volume, Control D, and then PE equals this, PE. And let's fix this just so we can look, so we can match the formatting. And there's other things you could do. Another good one is beta, but I don't think that this has beta. Oh, there's beta right there. Yeah, beta is a good one. You can see the volatility relative to the rest of the index. There you go. So you can do a custom sort here. We're going to do filter and sort, custom sort. So price smallest to largest, and I'm going to add, and then we want to sort by beta, and which is still labeled as column 1, and we do smallest to largest. There we go. And we're going to change this to beta. So you see that this company, the AES Corporation, I don't think I've ever heard of it, but in theory, if the assets and liabilities were real, then and the book value is real, then debt to assets was real, this would be potentially a strong buy if this stuff is real. Again, this isn't real. These aren't real numbers over here in the total assets and total liabilities. So this company could be in a lot of debt in real life, and I don't know. But based on the beta and the PE, it's probably not in a lot of debt, and it's got a good price. So you would want to look at that. Okay, so let's say we buy these companies, okay, and then we have a portfolio, and we want to start making a portfolio. So I'm going to spin up another sheet and create a portfolio real quick. Okay, so we want to start with, you can make it nice. We could do like a banner up here and fill these in. Let's say we just want to do like a fill with a nice like green money right there. And if you have multiple accounts or multiple brokerage accounts, you could do this one up here. You could call this your Vanguard, and then you want to go down here a ways, or you can make another page. How you want to do this? You can call this your Robinhood, and whatever else you got. There's a lot of different brokerage accounts out there, Interactive Broker, or whoever you have. You can just load this in here. And the main reason for this is doing a kind of a what if, or there's a lot of different reasons you might want to do this. Proposed purchase plan is a good one, or paper trading. Whoop, let me clear this out. Alt-HEA, there we go. Okay, and make your text white, bold, 24. There you go. Now we got our title here. Okay, so what we're gonna do is we're gonna go over to our sheet here, and let's say we're gonna start with just these top 10 companies right here. That's what we're gonna start with. Right. We're gonna paste that right there, and we're going to get rid of the fill, no color, and we need to get rid of the border. Should have done that while I was in there. None. There. Okay. And what I like to do is over here on the side, let's just push these guys over 1. And right here, I like to do because I like to sort these alphabetically, and if you try to do it with the live data, it will not do it. So we can do equals this, and you're going to look for ticker symbol. And just fill down. And then that way you can sort these A to Z, expand the selection, there. And now we can see our stocks alphabetically. And this helps when you're going to compare between your actual portfolio login. Usually brokerage accounts will allow you to sort by alphabetically. So you can compare and just quickly go through and make sure everything lines up alphabetically. All right, so we're going to push that over. Let's just add a little bit of space here. We're going to format same as below. What we want to do is we're going to put name, ticker. We want to do cost basis. So this is what it costs you to buy all the shares that you own. Current price, price to earnings, quantity of shares, current value. So this is going to be total value, or this is going to be current price times quantity of shares. We can do gain, loss, and percent gain, total gain, and then an important one is your weighting of the portfolio, so percent of portfolio, and then gain goals, goals, not goalless, and exit per share. So this is what it's going to be if you exit from at your goal point. This is the price it's going to be. Total exit or price per share that's going to be. Did I skip one? Yeah. Total exit. So this is going to be the total amount of money that you're going to have, and then estimated profit. And then another important one is you want to have a stop loss set up, and so whatever your minute, like if you're willing to lose 25%, 30%, 40%, whatever it is, you want to have your stop loss in there, and then the stop loss price is going to be the price you set your stop loss at. And then another important one is annual dividend. Okay, so let's stretch these out. All right. Now your cost basis, let's just say, for example, that we take these. We're going to go over here and take these top 10. We're going to go here. We're going to paste those in there. And let's do Control 1, none, fill, no color. And what we actually want to do is Alt HVS. See if we can still do it. No, we can't do it. Okay, so let's escape out of that. Let's just hide it because you're still alive. Control C, Alt HVSU. All right, escape. Now he's hard coded. Okay, then this one right here, the current price is going to be this cell. Let's click on it and do your price, and then fill that down. Okay, so this is interesting because I had sorted these alphabetically, and over there they were not sorted alphabetically. So now it looks like the current price, like we've taken a loss here, which is totally fine for the purpose of this. All right, same thing over here for the price to earnings. We want the live price to earnings. And then fill down. One thing you might want to think about doing is price to earnings when bought. And then, because one way you could do this is you could sell that, hey, if this thing gets to 23, 25, 30, but maybe we still haven't made a profit, you get to 23, 25, there's a chance that this is going to just drop again because it's above the historical average, and it's going to drop. And it might be a point that you want to sell just so that you can avoid a massive loss, which is 6 in one, half dozen the other. You could also do it with your stop loss if you know that you're going to have a loss. But anyway, I don't want to do the whole thing. All right, so quantity. So let's just say we bought, let's just do equals ran between. This is actually right now, because we're going to do a portfolio balancing feature. I'll show you how that works. We can just do that. Okay, so the current value is going to be total number of shares times the current price. And then do this again. Whoop. Do that. And then our gain loss is going to be current value minus the current price. Or sorry, the cost basis. So you can see we've lost $9 on that one. Some of those we gained. All right. And then your percent gain equals, I like to use this formula. Divided by original. All right. Alt H number percent. So we lost 42% on that one. That's fine. That's not really fine, but. Okay, and then your total gain is going to be equals, so what do we like to use? We like to use current price times quantity minus cost basis times quantity. And then your percent of portfolio, right, we have to do, to get that, we got to do an alt equals there. And let's do there we go. Okay, we're going to do equals value of stock divided by total value of all positions, and then make that a hard reference or a solid reference, and we're going to fill this down. Okay, and we're going to turn this into percentage, and then just to check that everything is summing correctly, we should get 100% there. Okay, so for our gain goals, you could create like a table over here on the side with different goals or whatever, 5%, 10%, 15%, but it's pretty easy just to do 10% and just fill that down. And then you're going to do exit per share is going to be your cost basis times this plus your cost basis. That should give you a 10% increase. Okay, and our total exit is going to be exit per share times total number of shares that we own. And then your estimated profit is going to be equals your total exit minus total paid. So it's cost basis times quantity. I'll just fill this down. Okay, now stop loss. So if you're willing to lose 35%, you're going to put 35%. Your stop loss is going to be your cost basis minus your cost basis times your stop loss. All right, and then whatever your annual dividend is, let's say that they have a 2.5%. Let's just say they all have 2.5%. And then your actual dividend is going to be, it's not necessarily going to be the current price, but be pretty close to the current price, as long as there's not a lot of fluctuations there. Okay. So a couple things we want to do for formatting. We're not sure which of these are formulas, which are hard coded. So you want to do, okay, so we know this is a constant. We're going to do font change it to your blue right there. Okay. And then we know this is one. That. And then these are, let's see if we can just hit F4 there. Yep, nice. And then this is, and then these are hard coded. Okay, nice. So we got everything that we want. So now what we can see here is that this one, Schlumberger, is 14% of the total portfolio. So to balance that, what you could do is you could go to, there's a lot of things you do. You only own one share, so you could sell it, and then that would fix the problem. But we don't want to sell it, but we don't want to have so much volatility. You know, we're overweight on this. So we go to this one, which is only 5% of the portfolio, and you could do Alt A, what if, goal seek to, let's say we want to make it 10%, so we do 0.10 by changing the quantity over here. All right, it'll get us pretty close. We can't buy 2.1 shares, so let's just say that we buy 3 shares. And that puts us at 14% of our portfolio. That's too much to do 2 shares. All right, so it's going to put us at 9.49%. That brings all this down. And then you can sort of work to balance your portfolio that way. You know, there's not a lot of stocks in here, so they're all going to be pretty sensitive when you change it, but that's what you do. And then what you do is, if you have what's called a order bracketing for your brokerage account, I think it's sometimes called a OCO, or it's a limit sell. And so what you do is you go into your brokerage account and you say that this stock hits 10%, because you do this based on historical averages, and that data is pretty available as far as average rate of returns and average PE prices and things like that. It's all pretty, it's all publicly available. And so if 10% is your goal, then you would just make this 10%. And you go in there and say, okay, the exit per share price, $24.26. And then you set your limit order, and it's good for 90 days. And you should be able to do a stop loss order too, where if something is absolutely plummeting, you won't have time to log into your brokerage account and hit sell. You need to have something that triggers the sell, so you can go in there and you can set a limit order for, hey, if we lose 35%, you know, the odds of coming back, unless you're in a very volatile stock, the odds of coming back after losing 35%, companies like AT&T don't have high volatility and things like that. So, you know, we intentionally picked companies with low beta. You want the stop loss. The odds of coming back after 35% loss are very low. And so you just want to have your stop loss, cut your losses, and then you just go buy something else instead. That's pretty much the end of that. You could do some alt equals here and do some totals. And so we're not doing so hot in this current portfolio. Do a sum here, see what your exit's going to be. And you could do your sum on your dividends. This is how much you're going to make per year if every single one of these stocks has an annual dividend of 2.5%. You can see what your dividend amount's going to be, and a lot of other stuff you can do. I'm going to bring in one other resource to help do a PE ratio or price to book ratio analysis. Okay, this website is what you would use to look up the current PE ratios for different industries. This is as of January 2025, and maybe you say it's old, maybe you say it's not, but if you look at things on a 50-year or 100-year averages, then you know it doesn't really change that much. I mean, there might be other data sets out there that are, you know, updated monthly, if you will. And I guess if you can make your own. If you got all the companies put together, categorized, you can make a whole sheet inside of Excel that would track the PE ratios of each company, and then you could do an industry average on your own. It's a lot of work, but you can get it from here. So you can see here, for example, we've got advertising as 54 firms, and let's see if I can blow this up a little bit for you. Yeah, so you can see here we've got 54 firms, and percent of money losing firms, trailing. That means their last 12 months trailing, they're losing money. 77% of them are losing money. That's kind of impressive. And then the price to earnings ratio is 514. The trailing PE is 291. Forward PE is 73. You Get some other data in here. I think if we go to the bottom, so total market, it's 57. Total market without financials is 59. So anyway, use this to take the PE for this industry, and then you can go back to your portfolio, and then when you do your industries over here, you could do a table that looks up you can download that data table I just showed you from the website, put it into a sheet, and you can do a lookup. Let me know if you want to see a video on how to do that, where you do a lookup of the price earnings ratio using this industry over here, and it'll go do an X lookup of the other table, pull that PE ratio and populate here, and then tell you if this current company is trading below or above the PE ratio for that industry. Because you could be at, for example, let's say Textron, okay, trading 18.49, which might seem good, but if aerospace and defense price earnings ratio is at 10 or 12, then this may not be good, because relative to its competitors, it's overpriced. All right, so that would be the purpose of going beyond just what's the average S&P 500 PE price earnings ratio, but what is the industry price earnings ratio. Anyway, hope that helps, hope that makes sense. If you like this, or if you had a comment for, if you had an idea for something that could be improved, or you want to see something in particular made, let me know and try to make a video about it. Thanks for watching.